Microsoft has joined the most exclusive of clubs. It's the third listed company, after Apple and Amazon, to briefly reach $1 trillion in market value.
It was another strong quarter with double-digit top-line and bottom-line growth, the result of picking the right secular trends, accelerating innovation, and maintaining a relentless focus on our customers' success.
The company reported a 19% jump in first quarter profits. It rose to $8.8 billion due to a boost from the cloud computing business. But Microsoft wasn't the only tech firm that had investors excited. Amazon smashed analyst forecasts by more than doubling profits to $3.6 billion. Its shares rose 2% on the news. The biggest gainer was Twitter, which saw its shares climb 15% as earnings tripled to $191 million. Facebook shares rose more than 9% after the firm said it added more users than expected and revenues rose by a quarter. The company is preparing for a fine in the US of up to $5 billion for failing to protect user data. Analysts are calling it a slap on the wrist for a company worth more than $520 billion.
Facebook and Instagram feed ads make up the bulk of our business today. We expect that to continue, but stories are an increasingly important growth opportunity. We are helping advertisers keep up with the shift in how people are sharing, just as we did with mobile.
Tesla was an outlier, reporting a larger than expected loss of more than $700 million. But the firm said progress in its autonomous vehicle program would pave the way for a driverless ride-hailing service to rival Uber and Lyft by next year.
All Tesla cars being produced right now have everything necessary for full self-driving. All you need to do is improve the software.
CEO Elon Musk says the new service will help bring Tesla back in the black. But if the company doesn't deliver, as it has in the past, it risks seeing its shares sitting idle as other tech firms zoom by. Paolo Montecillo, TRT World.
For more on the Silicon Rally, let's go to Mark Skilton in the UK. He's a professor of practice in information systems and management at the Warwick Business School. Welcome back to the program, Mark. Why are we seeing the tech sector stall, even though other equities are under a bit of pressure at the moment?
Yeah, it's almost like an exclusive club of the $1 trillion valuation, in which Microsoft has just joined for a period. Obviously, Apple and Amazon have been in that club, but they're just slightly trading below those numbers at the moment. I think it's just the scale of these large cloud platforms in the West. There's obviously the Chinese equivalent of Alibaba and Tencent and Baidu and others. I think it's just, to answer your question in a nutshell, is that they are so large. I mean, the reason why Microsoft has joined this club is that the cloud computing business, which you and I are using, even the connection I'm using to talk to you right now with the video stream, you're probably using a cloud service, is dominating the entire market.
And let's talk a bit more about Microsoft. It's considered one of the more legacy tech companies, very unsexy. We all have it on our computers, obviously. But tell us a bit more about why we saw Microsoft briefly enter the $1 trillion market cap club.
Well, the reason is it's looking like they've had double-digit growth in their sales again. I think Satya Nadella, the CEO, has managed to turn the company round, is focusing on the cloud, now artificial intelligence, driving traffic, driving volume in the business in Microsoft, and they've got their core proposition right compared to other, say, legacy companies I'll resist from naming. I think the focus here is around the future of artificial intelligence, where the growth markets are going to be. And I think companies like Microsoft understand that, and they have fed that market. Obviously, the licenses they're getting from their Windows software is still a business that is very profitable. They moved that as well into the cloud, so it's a subscription model. Cloud subscription model. So I think these subscription models, the Uber effect, if you will, is very big. And this is just a testament to their success around the world.
Interesting. Well, let's talk about Uber now, because as we know, it's already set its share price range ahead of its highly anticipated IPO. It's still a company that hasn't managed to turn a profit, though, but some estimates are putting the initial market cap at up to $90 billion. Is it in danger of being overvalued when it does list?
It depends which side you are in terms of the investor. If you're looking for shorting the stock, I think it's a long-running joke. The company's a very successful company, and I greatly admire it from a technical point of view. But if you look at the numbers, they just seem to just go focused on growth strategies, investing money. I think this is really like a lot of other big companies, and I'm just looking at a list there. Zoom, Slack, Pinterest are all pushing now to go to IPOs, to release some equity for their founders, to try and reinvest in the business. I think the Uber model, if you will, where you can start to sell, you look at, say, Airbnb, which is a very successful business model. I think this is the future, and I think this is why it's been valued so high. This is going to continue to grow, and I think this is probably overvalued by several magnitudes. But I think the confidence in this from the investor point of view is clearly there. I can't see, much like our previous question about those big cloud companies, unless regulation is going to split these companies up, European Commission, Californian laws around privacy data, so on and so forth. I don't think these are going to change direction at the moment, which is why they're being valued so high.
No. And Mark, before we let you go, we have to talk about Facebook very briefly. It's managed to defy its critics by posting impressive earnings, despite the prospect of a $5 billion fine from US regulators over privacy concerns. Why is Facebook making a big comeback?
Well, I think it's, again, there's the same answer really, is that there is little alternative. You and I are using Facebook. It's a great service that is easy to use. We have to give up our personal privacy effectively for them to monetize through advertising. There is no alternative at the moment, and I think this is the issue. They're clearly managed to turn a corner. They put a provision away of $2 or $3 billion, expecting a $5 billion fine in the US, as you had in your previous reporter. But the business model is still intrinsically safe, as it were, because it's such a core activity for many people around the world, and it continues to grow on that basis. Until there is regulation or deregulation to change the way social media manages yours and our data, it's not going to change. And this is one of the debates that's going on in many governments, particularly with the impact of fake news and regulation in that aspect.
Well, that's right. Okay, Mark Skilton in Warwick. We'll have to leave it there, but thank you again for your analysis.